I think you have to be a lot more flexible when you think about some of these newer business models when it comes to valuation.
Conrad Lauterbach, would you say the valuations right now are just simply too high in the growth part, or is there still, as already mentioned, this growth at a reasonable price somewhere in the market?
I think in general you could say they are too high. We recently made a top-down analysis looking at the NASDAQ, and we found out that on an enterprise value revenue basis, you have stocks trading above 10x in a share of NASDAQ that is as high as 2000. So that is clearly very high, and you always have to ask the question as an investor, I think, what do I get for the price I pay? So you can certainly pay a lot for a very good business model that is growing fast and that will continue its growth, but you won't be able or you should not pay that much for most of those businesses, because within those hundreds and hundreds of highly valued businesses, there will certainly be the next Google or the next Microsoft, but which one will it be? And the others will certainly move down in valuation in the future, and that might be getting ugly for most people who have this heavily weighted in their portfolios.
Plus, we've got rising rates in the US. This is the biggest problem, maybe, Matthias Schäfer, for growth stocks currently. We have to discuss with this environment with rising rates, high inflation, that especially growth stocks could get under pressure.
So I think so when you look at valuation, Mr. Lauterbach talked about EV to sales, and maybe it's a good ratio to show how high valuation is. So when we have interest rates from 2, 3, 4% raising in 6 steps, 7 steps, the valuation will go down, because I think a lot of bottom-up investors are valuating stocks with cash flow models. And when you look at cash flow valuation, you see that you have a terminal value, and at the end, when interest rates are higher, your terminal value will go down, and it's a big leverage on valuations on fast-growing stocks, even if they're not very profitable. So we are looking for stocks that are high growth, but high profitability growth, cash flow growth, and they have not the problems if you have a big capex on your balance sheet, I think.
I find there's in today's markets, it's hard to apply the same kind of valuation standard to the entire market. It's easier to use a traditional valuation model on relatively stable growers, something that may produce a solid double-digit form of growth or a solid double-digit growth in cash flows. It's easier to certainly model and discount back. But this market today and the technology today, you're talking about a lot of platforms out there. You're talking about a lot of models that have huge network effects that often can derive incremental new revenue streams as well over time. And you may start with a company that you value and invest in for one set of revenue streams, but find over time that they monetize new revenue streams as well. And so that valuation then has to be flexible enough to capture the potential for new revenue streams over time as well. I mean, using a U.S. example, I can think over the years of how many times we might have perceived Amazon to be "quote unquote" expensive, and might have considered selling it 5, 7, 8, 9 years ago, and would have missed a massive expansion in value over time had we been particularly rigid with that. But as they've grown and added revenue streams at very high margin from advertising, and as they've added cloud-based services, they find new ways to bring in more value. So I think you have to be a lot more flexible when you think about some of these newer business models when it comes to valuation.
So Sebastian, it seems like you're the only one who reduced growth.
I think the way you have to look at it is a little bit more from a broader perspective, because we're not investing in a fund or offering a fund to our clients, but a whole portfolio. And as such, growth is one part of it. And I think what you need to do is for your customer to be happy at all times, perhaps not maximizing his profit. That's what we can do, just buy NASDAQ and have him not look at it, but he will look and it won't work. So what we have to sell him is a solution for the harder times, and that has to include other factors apart from growth. On the valuation of growth, I think there will always be this breaks in technology, or like one of these, whether it be mega trends or disruptive opportunities, all these bullshit words or buzzwords. There will always be certain kind of events that make certain things rocket. At the moment, it's renewables, and in those times, the whole market is just throwing money at these topics, and so it's not really important whether you have a certain value or a PE ratio or whatever. You just have to look at the flows. So I'm with you, and you don't have to get too greedy, but kind of reduce when you think it's time. Still stay invested, but reduce. I think that's the kind of a blend approach to what we're trying to achieve.
Yeah, also from our perspective, as the definition of value versus growth, I do not understand the definition of value because it's such a heterogeneous picture. On the one side, you have telecom stocks in Europe. They are not growing at all for the last 10 years and even shrinking in next time. On the other side, you have oil stocks. 3 months ago, the oil price was 70. And for ESG reasons, nobody was able even to invest in oil stocks. Now, the totally different picture. Oil price is 120. We desperately need oil from other sources than Russia. And everybody's starting to invest in oil and commodities. Also, the office cash machines at the oil price at 120 because the production costs are still at 20 or 30. Also, so that is a huge difference. At the end of the day, it's the generation of free cash flow, what makes a company interesting. And you more free cash, you more growth, the better. That is at the end of the day. And the value segment is totally heterogeneous. Or another example, obvious, is the banking sector. 6 months ago, it was totally on vogue. Slightly higher interest rates, booming M&A markets, booming capital markets, no loan loss provisions. Also a perfect world for the banking industry. Obviously now loan loss provisions are rising. M&A market stop, capital market stop. They lose 50% of the profitability in 3 months' time. So now it's becoming a value stock again because the decline in earnings. Also at the end of the day, this definition value versus growth doesn't make any sense at all.